Sometimes in the investing world, investing is really easy. Stocks go up, you make lots of money, and you basically just have to sit and patiently wait to collect checks, increase your net worth, and overall just wait for these companies to get a little bit bigger. Today, the stock market went down a little bit. Generally, overall, the S&P went down about 0.85%, and all the indexes across the board were down around 1%. zero point 0.8 on the S&P, 0.59 on the Dow, zero point 0.8 on the Nasdaq, and down 1.1 for the Russell 2000. Now today was an indication of what the whole year has looked like. Because if we look year to date, this is where things get really interesting. Year to date, despite this really positive week that we've had these last couple of days, the S&P is still down 17, Dow down 8, Nasdaq down 28, and the Russell 2000 down 18%. And while this may look rough the last week, has really had an uproar with all these turning well into the green, with the Nasdaq now being up 6% plus just within the last 5 trading days. And you see this movement right here at November 10th at the open. Well, that happened all at once because of the release of the CPI report. Speaking of the CPI report, we're going to briefly go over this and talk about why investing, in my opinion, has gotten harder. In 2022, it has been very difficult to be an investor. It doesn't matter if you're short, if you're long, if you're an options buyer, if you're an options seller, if you trade some sort of complex strategy that no one else understands. Pretty much across the board, it doesn't matter what you trade. If you're buying pretty much anything, it has likely gone down in value, with the exception of maybe the couple oil stocks. So we're going to talk in this video while investing has got harder, the direction of the stock market, what the Fed is doing, interest rates. We're going to talk about discounted cash flow, and just the indexes in general. We're going to use this as a relation, of course, to my companies, like I always do. We're going to show how my investments are going to be infected in this market, which they have been all year. So stay tuned. It's going to be a fun one. Thank you so much for joining, and without further ado, my name is Jordan. I'm a millennial investor, and what we do on this channel is we have full transparency. This is my portfolio since joining this brokerage, and as of the time of me filming, we have about $42,800. Here's my performance, and speaking of my performance, here's my balance since starting YouTube back in April of 2020, my holdings as of the time of me filming, my performance year to date compared month over month versus those same indexes we were just comparing, my monthly YouTube income, my lifetime YouTube income, and all things known about my investments are disclosed on this channel. If you want to see my investing portfolios yourself, firsthand, this M1 Finance portfolio gives me the option to share down below in the description, so check it out down below. You can get $10 for signing up, and you would help support me in the channel. 133 people have done so far, and you can give yourself the opportunity to sign up for a free brokerage that has all the wonderful optionalities and platforms that we're looking at today. And so without further ado, let's go ahead and get started by looking at the stock market and why this stock market has had such trouble over the last year. Now, looking at the consumer price index, I highlighted this earlier, and you can look at all the different categories. There's a lot of pretty highlighted lines here, and it doesn't matter if we're looking at apparel or new vehicles, used vehicles, energy and gasoline, food items. It doesn't matter what we're looking at. It doesn't matter what the category. Across the board, you can notice that all of these are up. Obviously, the baseline is 0 down below. Let's go ahead and zoom in here. The baseline down below, around this 0% terminal rate, pretty much everything, let me rephrase that, every single category is up and away. I think the lowest one on here is medical care at 3.1 and used car and trucks still at 2% despite this massive downturn we've seen in 2022 with prices starting to come down. However, some categories, like some we've seen up here, have reached a ridiculous peak. At one point, fuel and oil hitting 106% for the year, and even the most recent month still being 65. Other major categories like natural gas hitting in the 30s. We have other ones such as just energy and gasoline in general hitting about 60. And this has really made it hard for a lot of companies that have higher input costs. And one of my main examples from this is Amazon. Amazon is one of my largest investments. Based on my portfolio tracker right here, you can see that it's my number 2 investment, making up 22.4% of my portfolio. And with this stock has faced a lot of troubles, and for the first time pretty much ever is putting up negative free cash flow. You see the long term here. You see billions of dollars getting raised every single year. Last year putting up 25.92 in free cash flow in 2020. The following year in 2021, we had a negative 14.7 billion in free cash flow. That is not good at all. In 2022, if we look at the most recent quarters, you've seen the same thing. The last 3 quarters being negative, negative, negative. About 30 billion in negative free cash flow throughout the year. And these fuel costs and basically just rising input costs in general have caused a lot of this downturn. Now, there are many companies like this that have seen huge downturns in share prices, not only because of these rising costs, but because of another reason as well. And that is is the interest rates that have been rising. We have been seeing interest rates go up anywhere from the pace of 25 to 75 basis points every single Fed meeting since March of this year, over the last like 8 or 9 months or so. Now, looking at the Fed futures now, we're projecting that the next hike will likely be at 50 basis points based on these futures, based on where we're at today. These change all the time, so this could change later, a week, a month from now, by the time that you're watching. But long story short, it's being driven by this man, which is Jerome Powell, which is the Fed chair who is determining these rate hikes right here. Now, it doesn't matter whether or not we're going to hike 50. It doesn't matter whether or not we're going to hike 75. The moral of the story is a 4+% interest rate is significantly higher compared to where we were just 1 year ago at 0. 0 versus 4.5% is a significant difference that is way higher than not only what we were expecting to get this year, but way higher than what we could have ever expected within the last decade or so. And now, why does this make a difference? I just want to give you a quick example. This is not a specific stock, this is not a specific company, but just so you can see side by side what this looks like. Okay, what we have here is we have a company that has net cash flow of $10,000, and it's expected to go over the next 10 years. Obviously, this is a basic example. This is not a specific company, once again. But if the weighted average cost of capital, we'll even enter today's. Today is right around 4.5% is the Fed funds rate. So the average cost of capital is likely going to be somewhere, maybe on average, let's say somewhere around 8% maybe. Obviously, it'll depend on a lot of different things like the company's credit rating, like their cash and debt, future cash flows, lots of stuff like that. Now, let's assume that the company is a pretty good growth company. They're growing 10% a year. Just as an example, we used Amazon again. So if you look over the last several years, in the last 10 years, they've compounded at 25%. Now, that is very high, and I don't expect it to keep compounding at that rate, but it's pretty standard as growth stocks to hit double digits, about 10% growth year over year. Many of the companies that I invest in, like Google, Amazon, Salesforce, many of these companies continually grow 10% plus year over year, and over the last 10 years for Google, they've grown 21% compounded. Now, going back to the discounted cash flow analysis here, if you expect 10-year annual growth rate or 10% annual growth rate year over year compounded, and you expect 10 years worth of cash flow, and the cost of capital is 8%, then your net present value, your NPV of the business, is worth about $100,000. Now, let's keep everything constant. The company still makes the same amount of cash flow. The company is still expected to survive for the next 10 years, except let's change one thing. Let's raise interest rates from 8% to 10%. Our $100,000 business now goes down to $90,000. That's a 10% downturn just by interest rates going up 2%. What if we take it up another 2%? That 100 down to 90 now goes to 82. And you can see the higher this goes, the lower the net present value or the NPV of the business goes because the interest rates are higher and it's harder for these companies to grow. But what you're having is simultaneously, not only is it becoming more difficult to presently value these companies based on their cost of capital that is rising, but their growth rates are slowing down. So let me give you an example. Let's look at Google here. You see right here. Over the last year, they grew 41%, but that was kind of an anomaly. The long-term average we've seen, looking at the 2, 5, and 10-year growth rates, this company generally grows around 21%. Now, what are they doing in 2022? Well, after their most recent quarter, they're only growing 6%, which is significantly lower. And that is across the board for pretty much all of these companies, right? If you look at a company like my largest investment, like Salesforce, if you look at its most recent years, you can see that over the last 10 years, it's growing at 27%. But if you use the most recent quarter as an example, it's not growing 27, it's only growing 21. Growth is slowing down because recessions make it harder for companies to want to spend and reinvest back into themselves. So you not only have to raise this cost of capital, but you also have to lower the expected annual growth rate because people are not spending as much. They want to put that money in a savings account. They want to protect themselves from job loss. And this is what makes things dangerous. Let's raise this 8% cost of capital to 10, and let's lower this expected annual growth rate to 8. Well, now you don't have a $90,000 business, now you have an $83,000 business. What if interest rates keep rising up to 12% and your growth slows down to 6%? Well, now your $100,000 business is a $70,000 business. You get the point. You can mess with these numbers. It's not about a specific company, it's about the principle in general. If you're investing in growth stocks, if you're investing in companies that cannot continually grow their business in a way that can outpace inflation, outpace these interest rate hikes, then you're likely going to struggle. Luckily, companies like mine that I invest in, including my largest investment, Salesforce, is still growing a ridiculous 21.77%, which is far beyond a 4% interest rate, and that will far from even come close to the growth that Salesforce will have. However, it has dented its growth rates and it is closing in on that gap. So when you look at the indexes here, we finally had a CPI report that was lower than expected, and inflation did not come in as hot as many investors were thinking it was going to, and stocks rallied. And at the end of the day, it comes down to one main thing. If the Fed it continues its rate hikes and inflation runs rampant, you're going to see the stock market go a lot lower. And if you look over the last 5 years, you can see that it's easy to assume that while we've seen so much pain over the last 12 months, you might be thinking it's over, but I hate to break it to you, it's all down to one thing, and it's this consumer price index. Whatever this does will directly correlate with the stock market, and if it comes down, stocks will rally, and if it goes up, stocks will likely hit new lows. So that's what you should be looking for, and that's what you should be thinking about. But in the meantime, no matter what these companies do, no matter what the interest rate does, no matter what the Federal Reserve is planning on doing, if you invest in long-term, growing, profitable businesses that are increasing their revenue, increasing their free cash flow, you're likely going to come out on top whenever it is, whether that's tomorrow or 5 years from now. Whenever this happens, whenever the stock market turns, you want to be sitting pretty with high-growing, fast-growing, profitable companies that will set you up successfully for the long term. Thank you guys so much for watching. Check out all the stuff down below in the description if you haven't already. My name is Jordan. I'm a Millennial Investor, and I'll catch you guys next time.